This time on Trillions, how to think about inflation and many other things with Jim Bianco. Jim, welcome to Trillions.
Hey, thanks for having me.
So, Jim, I gotta ask you, what do you do? What's the, you're president of Bianco Research, obviously doing a lot of analysis, but break it down for us. What's your job?
Whatever I want it to be. That's why I like it. But seriously, I'm a macro researcher and I'm an independent person. So I tend to look at the macro space by saying, okay, what isn't being emphasized enough? What do I think people have wrong that I should explain? What do I think they have right that I think needs to be amplified? And so within the macro realm, I tend to kind of find those topics and choose which one I want. And I can be very eclectic. In the fall, I was doing a lot with polls on the election and about how I thought that the election was going to be far closer than people thought it was going to be. And my big whipping boy back then was Nate Silver, who was giving Trump something like a 9% chance of winning the election. I still thought he was going to lose, but I thought it was more like a 55-45 race than it was a 91-9 race as well too. My bailiwick has always been the bond market, and I always kind of start there because it's kind of the most natural market for a macro researcher because it brings in policy and it brings in economics, which I spend a lot of time doing as well too. What I don't do a lot of as a macro researcher is individual securities. So if you're looking for QSIPs or tickers, I might not be your guy. I've got some, but not really as my big bailiwick.
And who are your clients?
Institutional investors around the world. I am affiliated with a brokerage firm called Arbor Research and Trading out of Chicago here, and they've got offices in Chicago, in New York, and in London, and salesmen in Chicago, New York, and London. And so we have clients all over the world. And we also sell our research as part of a research subscription basis. If you don't want to subscribe to it or you don't want to do brokerage business as an institutional manager.
And so, Jim, I see you tweeting about ETFs now and then. They seem to be worked into your workflow. How are they related to you? Are they a natural investment tool for the people you're writing research for, or are you more looking at them as ways to read sentiment and get intel from the market and investors?
Both. I think that there's a number of institutional investors. We have a number of wealth managers. I love to tell this story. We have a number of wealth managers as clients, and I was talking to a wealth manager on the West Coast. This is, 4 or 5 years ago, and he was saying to me, I like high yield and I've instructed my desk to buy high yield. And I was like, really? You've got a desk? You're a wealth manager, you got a desk? And he goes, well, it's kind of my wife on a PC and I told her to buy me some HYG. So that's kind of, there's a lot of institutional managers that when they say that they're long a particular sector, short a particular sector, they're talking about the ETFs that they've bought or sold as well too. And they provide a tremendous resource into sentiment by looking at the creation and deletion of shares and looking at the NAV premiums and discounts as well too. You could glean a lot of information about the psyche of the market as well. So they work for me on both ends in that respect.
So let's talk about ARK, which is the ETF topic of the moment. You've been following ARK. I have. We all have. I mean, you can't take your eyes off of it when you see a company go from 3 billion to 50 billion in a year. It's a phenomenon, or craze. We have many terms for it. But I just want to get your first overall take. I think right now the big debate is, okay, this company has killed it. They've grown fast. And now you've got this sort of a bunch of worriers. Not totally clear their motive, but people are talking about, there's concentration risk. Some of the stocks that the funds own, they own, more than 20% of the shares outstanding. It could be a dozen of those, roughly. And so they're worried, well, what if there's outflows? There's going to be a liquidity issue and potentially. And I heard one guy today was like, ARK is the new long-term capital management, so you're really seeing a lot of hyperbole as well. What's your take on it right now?
Well, first of all, at the top, let me disclose that I own all 5 of the ARK funds. So I am a big fan of Cathie Wood and the structure of ARK. So keep in mind that my comments come from an admirer of the fund. Now that I've said that, I think there's a lot of people that are very jealous. They're jealous of the performance of ARK, might be jealous of Kathy as well too. I won't say that they're sexism, but I just did as well too. But let me be specific. Yeah, they've got an issue with the concentration. So did Warren Buffett in the 1980s. He was as concentrated as she was by having a handful of companies that he owned, that he sat on the board of most of them as well too. So this is not new. And yes, it does pose a risk. And no less than ARK and Wood themselves are regularly putting out YouTube videos and research explaining that risk. And yes, they do disclose every day what they're doing in their fund. They have to by law because they're an ETF, and they go the extra mile by emailing out all of their trading every day as well too. So it's a very transparent fund. As far as the idea that it's going to get so bad and that the outflows out of ARK are going to get so bad and that there's a bunch of people that are going to say, I told you so, I got news for you. If it gets that bad, it's going to get that bad for you too. It's not, ARK is not going to blow up and the S&P is going to just sit there and go sideways while that's happening. If you're talking about ARK being a long-term capital type of problem, the S&P is going to look a lot like last March as far as what it will be doing at the same time. So I don't understand this hatred. Yeah, you could make the case if you want that the sector that she's playing in is overdone. There might be a stiff pullback. There was last week, as we are talking about, and there might be further downside. That's one story. But to say that they're going to come unglued is essentially, in my mind, saying the whole market's going to come unglued because there is a strong correlation between those stocks and the rest of the market. They're not going to go down and fall apart while everything else is just going to sit there and do nothing.
Yeah, Jim, I completely agree with you. I just want to add a couple little tidbits here. One is that ARK also owns some pretty big names. They're able to sort of manage liquidity, and they've only seen a week of outflows, and those outflows were 1.5% of the assets. And like you said, when if her fund went down last week, well, a lot of things were down last week, and this reminds me of a lot of ETF issues where you can create these scenarios on paper, and they really end up with, you have to be able to, you might have like a World War III scenario before that plays out. And I think people do try to isolate it instead of just sort of considering it as one thing in a bigger picture, because also 50 billion isn't that big. But we have looked also at ETFs that have really risen up this quickly. And typically outflows do not come out as fast as they went in, because there's people who are waiting to buy the dip. You know, she got a big core fan base. So there could be a tug of war. There could be a rebound. And there also could be people who just forget they bought it or are just in for the long term. So I think this scenario that all of a sudden there's going to be a run on her ETF and the flows are going to be so bad she gets stuck in a liquidity issue, and and somebody even said she's going to have to be bailed out. I mean, this is getting pretty ridiculous. I think at the worst case scenario, if everything's going to hell, it's possible she could have a little trouble with a couple stocks and it could trade at a slight discount if there's a pull on the ETF to get out. But I don't know. I just don't see anything worse than that. What would be your worst case scenario, Jim?
Looking at some of the ETFs in the credit space, especially HYG, let's talk worst case scenario. Remember, there's payment in kind. If things get bad enough, you could just in redemption, you could just hand them the shares is what you could do. You don't have to liquidate the shares and hand them cash. That's if you get into the worst case scenario. So there is not necessarily that case. We've seen that with, like I said, as a matter of fact, with HYG, the high yield ETF, that's an actual strategy as far as payment in kind in terms of handing shares and receiving shares as part of the trading strategy of that fund as well too. So that would be, I think under the worst case scenario. But let's also remember, I know she was much smaller, but 1 year ago, her strategy was she was buying a lot of big liquid names, the Microsofts, the Apples of the world and stuff. And then in the sell-off in March, liquidated those names to pick up a lot of the lesser liquid, higher flyer names as well, too. And I've seen some of her research saying that's the strategy they want to employ in the next downturn. And then finally, I'll say one other thing, too. In the last 2 weeks, she's come out repeatedly and said she expects a stiff correction in the market. So I think part of the thing about them getting in trouble is they're caught flat-footed in something they don't anticipate. Well, she's been anticipating a correction in the market. So I have to believe that, she's been positioned for it, been ready for it. It's not shocking her. She's not staring at the ceiling at night wondering what's going on because our funds are selling off as bad. Because it was literally 2 weeks ago she said she was ready for something like this.
So, Jim, I want to actually take a moment and talk about the fixed income world, since that's something that you're deeply rooted in as well. How existential of a moment is this for fixed income and bonds?
I think it is fairly existential because my view, and it's becoming more of a view in the market, is we're about to turn tact here and start to see something we haven't seen in maybe 30 years, and that is inflation. We're now really openly looking at that idea. Over the last 25 or 30 years, we've had bouts where people have talked about inflation, but it really hasn't materialized to any great degree. And in fairness, as of right now, it hasn't materialized. But I think the evidence is the strongest it's ever been that we're going to see inflation. And that is going to be a big game changer, I think, in the fixed income space that a lot of people are not ready for. For instance, inflation is historically not good for equities. Everybody says it is good for equities. They said that in the early 70s when we first got inflation too. The best hedge for inflation was equities. By the late 70s, we realized it was one of the worst in hedges. Companies can't raise prices as fast as their input costs and their margins get squeezed. That's what typically happens in terms of inflation. And the other big one for inflation is the 60-40 portfolio, the bedrock of the wealth management business. And why you see these, I believe why you see these relentless inflows into fixed income ETFs is based on the idea that you don't have inflation because stocks and bond prices tend to move opposite each other in the lack of inflation. Or yields and stocks move together. I'm saying the same thing again. And we've even coined a phrase for it, risk on, risk off. Well, in an inflationary environment, you have not a 60-40 portfolio, but you have a 100-0 portfolio. Either both stocks and bonds are going up together or both of them are going down together. And we started to see the beginnings of that happening, especially last week. Both stocks and bonds went down together last week as well, too. If this inflationary environment comes, then the whole basis of a lot of wealth management strategies has to be rethought because that 40 leg stops working. And then they're going to have to figure it out. One last thing for you. Remember why a person goes to a wealth manager. If you're bullish, you just go buy ARK or you buy the S&P. You don't need to go see a wealth manager. You go see a wealth manager because you want to participate in the market, but you're afraid. So their ready-made answer, and it's not been a wrong answer, has been the 60-40 portfolio or some variation on that. Well, if that stops working, then all of these clients that wealth managers have are going to start asking questions. Why is my portfolio falling as fast as the market if both stocks and bonds are falling? I thought that 40 leg was supposed to protect me because it certainly didn't help me when the market was going up. I always lagged behind the big rally in stocks. So I think that there is going to potentially be an existential point with the bond market if we were to see this inflation materialize like I think we are.
Let me be devil's advocate here. And, there's that, you ever heard that Rolling Stone song? It's just your 19th nervous breakdown.
Sure.
Sort of making fun of, here you come again with another nervous breakdown. I feel like I've seen this movie 19 times before. Rates start going up, how to prepare for rising rates. And then stocks start to go down a little bit. Everybody freaks out. And the Fed comes in and says something that just makes it all good. Rates decline, stocks go back up. We're partying again. And what makes you think we're not going to go back to that again? And this is a new paradigm.
You're right. This is a story that we've heard in the past. Now, in defense of me, I only became an inflationista last summer, so I'm fairly new to this. I was a big bond bull until last summer as well, too. But what I think is changing now is the perception of inflation itself. Modern monetary theory, universal basic income. We're mailing people money as well. We're talking about $1,400 checks and an extra $300 of unemployment insurance going out. And by the way, I understand completely why we're doing it. But what I've often argued is if there is no consequence to us mailing out all of this money, that we pass a stimulus package, and the poor get some help, and the unemployed get some assistance to their next job, and the rich, define the rich as anybody who owns equities or assets, if you want to even draw it broader, see the value of their portfolio go up, everybody wins. So let's do another one, and let's do another one. Why wouldn't you do another one? If you pass a big stimulus package and you mail out $1,400 checks and everybody wins, then do another one. And you enter kind of a UBI MMT world. And that's where I think you get the stimulus for inflation. So that's been my argument. Now, I've also argued you don't have inflation now. It is a bet that it's coming. Immediately ahead of us in the next 60 days is what economists call the base effect. In April and May of last year, when the shutdowns happened, the prices of everything plummeted because everything was closed and everybody had supply and there was no customers. So they were cutting prices to move inventory. That rolls off in the next one or two inflation reports. So the year-over-year change of inflation is going to jump dramatically. Everybody knows it. Chairman Powell has said it a million times. It's going to happen. Don't be surprised. So you've got your ready-made excuse for higher inflation over the next 60 days. My bet is that in the second half of the year, we're going to start looking around and going, well, that base effect didn't go away. And maybe it didn't go away because we've got all of this stimulus that we've put into the economy. One last thought for you. A lot of economists say you can't have inflation without wage inflation. And there isn't really much in the form of wage inflation. Well, that's true for now. But what I've argued is you have personal income inflation. Astounding number is personal income is the total income you make. Wages is a big part of it. Unrealized gains on your securities is a big part of it. 25% of that number comes from government transfers. That is stimulus checks, unemployment, Social Security, disability, veterans benefits, whatever else the government mails. It's an astounding number. It used to be pre-pandemic around 8 or 9%. A quarter of the income of the United States is mailed to them from the government right now. And the savings rate is tremendously high, well over 20% right now. So that's given everybody a ton of money so that as soon as they get their vaccine and as soon as they feel a little bit better and everybody says we're going to come roaring back, they've got money to burn. And I think it will show up in the form of inflation. And if it doesn't, then the argument will be, we'll send some more money out. It was all good. We sent them all money out and only good things happened and no bad things happened. So we'll just keep going until we eventually get there. That's the basis of my inflation argument now. And you're right. There was various variations of this. There was a variation of this in '08 when we said with QE, there was a famous letter that was signed by about 60 people on Wall Street that Chairman Bernanke, you're creating hyperinflation with all this QE. And it never happened. And so I get it that there is that skepticism, and it could be wrong again, too. So we'll see how this plays out for the second half of the year.
So when you think about this inflation talk, Jim, I mean, it's very easy to picture it as this boogeyman like we had in the 70s, right? But it's also part of what you're saying here is like we don't necessarily know how big of a boogeyman this could be too, right? Like it could be a little bitty version of that boogeyman, but because we haven't had it for so long and we have no sense of how this whole thing could get metered, we don't know how big this of a phenomenon this inflation talk could turn into.
You're exactly right. So when I say I'm an inflationista, there's two thoughts that come through people's minds. If you're a little bit younger, you say, okay, Zimbabwe or Venezuela. So we're going to 1,000,000% on inflation or something like that. Or if you're a little bit older, you think the 70s. We're going to double-digit inflation. And I'll then turn around and say, no, actually, my target on inflation, core PCE, a Fed favorite, is 2.6%. That's not inflation. That's what the Fed wants. And I've said, no, wait, 2.6% is a 28-year high in the inflation rate. So let's start with a sustained 2.6% inflation rate. What I mean by sustained is you'll probably get there in the next 2 months off the base effects, but then will you stay at somewhere near that level after that as well? And if you do get to 2.6 and the market starts to think, wow, this is kind of like the new level for inflation, and we start getting positive real rates, you have a 3% 30-year, 3%, 10-year, probably pushing a 4% 30-year. In the bond market, with all the leverage that's in the bond market, that is a very painful move for the bond market. Look at the way that the market wobbled over the bond market hitting 1.5% last week. You double that over the next several months or year or so, and I think that could be very painful. Wall Street's right. It's not the surprise. The surprise is not that rates are going up. It's the speed at which rates are going up. But that's what's got me worried, is that I think that the only way rates go up is with a quick speed, because it is a realization that we've got inflation coupled with a very levered bond market, and that will put the whole fixed income market, in a bad place. And if the bond market's in a bad place, all markets are in a bad place. So that's the risk that I see in the market right now.
So what's an investor supposed to do? I've got that 60-40 breakdown. What am I supposed to do with that 40?
Yeah, call your wealth manager and ask him what you're supposed to do with it. I guess what you need to do with the 40 is start to ask yourself, what is a natural hedge to the stock market? See, the great thing about the 40 used to be the bond part is that bond and stock prices moved opposite each other. So you had 60% in equities, and when it went up, you made some, you participated, you went up. Not as much as if you were 100%, but you went up. But when the market fell apart, bonds were supposed to rally to cushion the downside. That hasn't happened. So what's an investor supposed to do? Here's the hard part. What's negatively correlated to stocks if we get inflation? And the answer is not much at all in terms of where we are. You're in some kind of a 100-0 environment. You might think about, reducing your risk, maybe running an 80% portfolio with 20 in cash. Just running higher cash levels, because, you'll go up and down with the market, as opposed to a 60-40 with zero cash, 60 equities, 40 bonds. That might be one way to look at it. Or another one is maybe something that is negatively correlated will emerge. But right now, everything's in such a state of flux. I'm not sure that there is anything that is negatively correlated to equities like bonds have been for the last 20 years.
So, this is where I think alts have a time to shine, because we have seen alt ETFs. These are ETFs that do something market neutral where they have a short side to them. Those have been completely ignored. And even in the hedge fund space, if you're like a true alt, you tend to not see any flows. Only the ones that lean towards stocks or beta tend to get flows. So there's this sort of beta vortex forming no matter what the strategy is. But the people who do the pure things like a deep value or an alt ETF that have been totally ignored and live outside of the beta vortex, does it make sense to think about those as a portfolio diversifier now before it starts raining, so to speak?
Yeah, absolutely. And I'd also throw into that mix the smart betas as well, too. I'm a big fan of the smart beta concept as well. And I know it's gotten a bad rap because the smart betas, they've lagged the market, but their argument has always been that over a complete cycle, that they'll do better for you. With smart beta, again, it's still the same 500 stocks in the S&P, but instead of weighting it by market cap or price, you weight it by some fundamental measure like price to earnings ratio or price to book value or cash flow, so that the companies with the better valuations get bigger weightings. You just don't always have Apple as your biggest weighting because it's the largest company. As well, too. They're not doing as well in the up because all the racy stocks go up, but they do better in the down. So that's another one. But yeah, I think that those types of strategies might be better strategies for people that are worried about risk or worried about corrections in the marketplace. If indeed, as we continue to move forward from here, the bond market does not exhibit that negative correlation that we all wanted to make it the natural hedge for the stock market.
Now, there was you had quote tweeted Kathy, coming full circle here, and she had said something like bonds are pretty much over. The new 40 is Bitcoin or crypto. You quote tweeted that, and I want to get your take on that position, because I think it seems to me, and maybe I'm wrong, this is my gut instinct, Bitcoin is a plaything of a bull market. In other words, and we saw this last week when the candidate Bitcoin ETF launched up there. It traded like crazy. It was seeing like $250 million of flows the first couple of days. Then Bitcoin got smacked and the equity market declined at the same time. And then it went down to like 25th in volume, because when it starts raining, people, they don't think about that stuff. They go to the core. They think of their equity and bond positions. And it almost seems like Bitcoin will just go down with a risk-off sell-off and provide no hedge. Am I wrong?
No, you're right. The concept that Kathy said that maybe Bitcoin is the new 40%, I'm with her on that idea, but we're not there now. The problem is Bitcoin is still positively correlated with equities. So if you open a Coinbase account and buy some cryptos or Bitcoin in particular, it's going to go down when the stock market goes down, like last week, and it will rally back when the stock market rallies back. So it's not providing that negative correlation that people think that it would provide, or, it does its own thing to help give you some kind of a diversification. Now, maybe over time, if it becomes more accepted as a legitimate asset class instead of a speculation that it would be an asset class, it could evolve into that. That's where I think then the 40% makes case. But I think it's too early right now to put it into that category, that it is a natural fit for a portfolio diversifier. It's a speculation. I own some cryptos. I don't own Bitcoin at the moment, but I own some others. But very, very tiny amounts that if I lost all my money, it wouldn't change anything for me. And I'm doing it to more learn about the space than anything else. And I understand what's going on in the space, but it's still too early to start thinking about that space as another asset class to compete with stocks and bonds.
So it does seem like just of late, it's really turned a corner, Bitcoin specifically, in terms of just having a certain zeitgeist among institutional investors. And I'm curious, what you hear from your clients regarding Bitcoin, and then sort of like what's your long-term view on where you think it could go?
So you're right. It has seemed to turn the corner, and I've referred to this as the adoption rally, because what you're starting to see, not only with Tesla and MicroStrategies and the new Pulse ETF in Canada, but you're seeing companies now embrace it. Square is another one as well too, that is starting to embrace and starting to look at these as a potential corporate strategy to own some kind of a cryptocurrency as well. My clients, they're still somewhat mixed. There's a fair number of them that scream tulips and that we've lost our mind and what are we doing, trading a bunch of bits and bytes that have no value and pretending that they do. And then there's others, and I kind of put myself into this camp too. Oh no, this is the leading edge of a huge financial disruption. Now, this disruption's not happening this year or next year, but it's coming, and especially in the space of decentralized finance or DeFi, I think that it is a big deal what is coming down the line. And what we're seeing is version 1.0 of that change. Yeah, it's the buggy version that has problems, but there will be a 2.0 and a 3.0, and it will get better and it will get better. And then it'll come more into focus that it will compete with what the crypto space calls CeFi, centralized finance, which is what we have right now as well, that it will become a new era for us. So it's risky. And the biggest risk you have, I've said to people, I personally believe that this is going to be a big disruptor and game changer. But there's so many protocols and there's so many coins that are competing to be the winner in that space that I don't know which one will win. So I've said it's like you've stumbled on a racetrack And, there's a horse in there, or a bunch of horses at that racetrack that can win you money, and quit talking about whether or not they're going to close the racetrack down and try and learn about what the horses are doing and try and figure out which horses are going to win. And so that's kind of where my clients are. Some of them think we got to close the racetrack down, and the other ones are saying, well, which horses do you think might emerge as the winners out of this big race that we're having right now?
Speaking of horses and horse race, one of the big debates in the ETF nerd community is whether they're going to approve a Bitcoin ETF. And I guess I want to get your take on the odds of that, whether it's a good thing. And then finally, what do you think the SEC should do? Because if they approve one, they're kingmakers. They're going to make those people rich instantly. We now know there's probably going to be about 10 to 15 billion in like a couple weeks into whatever one's out first. Or should they approve, 5, 6, 7 at once to give a level playing field?
Well, the big game changer there is Gary Gensler. So Gary Gensler is the Biden administration's appointee to be SEC chairman. He is a big crypto advocate. He was a professor at MIT and taught a class on blockchain and cryptocurrencies as well, too. The head of the crypto area of the S&P, I can't remember her name, but the woman who investigates crypto on behalf of the SEC now will report directly to the chairman. So this has got the hype going that we got the guy in place that will approve it. If anybody's going to give it its blessing, it's going to be Gary Gensler. And he hasn't been approved yet, but he should be shortly. And once he is, then start the countdown clock until we start to see some crypto ETFs. And my answer is sure, why not? We've got volatility ETFs. We've got inverse levered ETFs. As long as it is disclosed as to what you own and what you don't own, I don't see a problem with any of that. As long as you don't pull a tether, and what I mean by pull a tether, that's the cryptocurrency that's supposed to be a stable coin tied to the dollar, and they were supposed to have a trust. So for every cryptocurrency that was out there with $1, there was $1 in a bank account. There was no money in a bank account. So as long as you don't pull something like that, yeah, I think it would be perfectly fine, and that people will understand and embrace what they're going to do. And you're right. There's all kind of people on the runway that are ready to do it, and I understand why too, because you want to own it in a regulated account because you've got some of the protections that people are comfortable with. In the crypto space, I don't know if you guys have a crypto account, and if you've got more than one crypto account, I've always loved this. If you've got more than one crypto account and you try to transfer money between one account and the other, you've got to make sure you're on the right network, you've got the addresses right, and they give you literally quizzes and about 8 warnings. If you don't do this right, and you mix or get the addresses wrong or mix the networks you're sending from one to the other that you can't do, as soon as you hit send, your money vaporizes. It's just gone, and don't call us up whining that you lost your money. And so that scares the hell out of a lot of people that they want to go into that space and deal with that potential mistake. As I once was joking with my wife when I was trying to transfer money, the cat jumped up on my desk. I said, she steps on the keyboard, my money disappears forever and stuff. So yeah, I'd like to keep it in my regulated securities account. So if the cat steps on the keyboard, my money doesn't disappear. So that's the allure of the Bitcoin ETF and why so many are so lined up and everybody wants to jump into them.
I think that should be the commercial. That should be their commercial. The Super Bowl ad is the cat jumping on the keyboard and it's all gone. And then it just says like Bitcoin ETF.
Yeah.
The cat ate my Bitcoin is definitely going to be a meme.
Yeah.
Speaking of memes, just lastly, to have a little fun here and to talk about something that is wildly entertaining, but hard to see how much consequence the meme stocks, right? GameStop. Early this summer, and I also saw you were all over Dave Portnoy. He was able to sometimes move some of these smaller names like cruise ships and whatnot. What's your take on this sort of populism, democratization, commission-free trading movement where retail investors seemingly are able to unite a little bit, develop cult followings, and push stock prices around? Do you think this is here to stay, or just the pandemic phenomenon and a bull market phenomenon that'll go away when people start getting out more, or there's a correction?
No, it's here to stay. It's definitely here to stay. Now, you're right. Once the weather warms up and we're allowed to go back out again and, commune with other people, there might be a little bit of that backing off, but it's not going to go away. Memes, let's be honest, memes kind of drive the world. Narratives drive the world right now in the way that people live their lives, and now they invest. And I think that a lot of other people in the traditional financial markets are also a little slow to understand the powerful network effects that things like social media have. Wall Street Bets is the top of the list now that everybody's looking at. That I've heard people, traditional financial people say, yeah, well, there's a bunch of influencers, to use a modern term for that, what they're saying about them, that are suggesting on Wall Street Bets we should do this or that. And then there's a bunch of sheep that just do what they say, maybe because they've had a hot hand. I was like, isn't that kind of what professionals do on Wall Street too? There's a couple of, well-known hedge fund managers that come out, or Warren Buffett, and they wag their tongue that they like this or that. And then all of these highly paid professionals run into the same idea as well. Why is that any different than what we're seeing on social media? Oh, but these people only have $500 in their account. Yeah, but multiply it by millions and throw in options trading, and the network effect is tremendously large on this. And the economic benefits are there. They've got zero commissions. They've got fractional shares as well too. So there's no disadvantage to being small. There's no disadvantage. Don't worry if Amazon's $3,300. You could buy a tenth of it for $330, and you could do it on zero commissions. And if you're really bullish on it, you could buy one option on it for zero commissions as well too. And this whole community is out there to help you. So I think this is the new way. And we've got the internet, so that, take your pick of your favorite, most sophisticated hedge fund manager. He doesn't have any more information than you or I or anybody else does. He might have more knowledge on how to use that information, but we all have the same information right now. So I think that this is transforming the way that investment is going. And then throw in one other thing too. These tend to be younger millennials, or maybe even Gen Ys, or maybe even 13-year-old kids, for all we know, that are doing a lot of this stuff. And what do they want to invest in? They want to invest in what ARK is investing in. They call her Kathy Bay for a reason. Bay, B-A-E, before anybody else, is what the Bay stands for as well. So they want to invest in the next generation. Well, a staid money manager who's got an office in Boston, he's not investing in a lot of those stocks if he's an active manager. S&P 500, well, we just got Tesla into the index right now. A lot of these stocks aren't in the S&P 500. Oh, maybe some of them are in the triple Qs, but that's dominated by the big FANG stocks anyway. So now they're saying, this is what I want to invest in, the next generation, the disruption. So big Boston active manager, where's your disruption fund? And, their disruption fund is, let's buy some Microsoft and Apple. Well, that's not what I'm looking for. Index, do you own this stuff? No, not really. I could do it myself. And I've got a community that I could communicate with in terms of social media. It's not just Reddit, it's Twitter, it's StockTwits, it's Motley Fool, it's Seeking Alpha. There's a lot of places that people can go to get this information. TikTok. So I do think it is a big change.
It is. It's fascinating, and I just pretty much agree with everything you said today. I think. Joel, how about you?
Hi.
We're in trouble.
I'm not gonna. I never tell a source, that I'm all in on everything that he said. But I do appreciate your assessments. I think they're definitely, some of them are provocative, and a few of them are also grounded in, I think, a reality that it does when you do some attempts at analysis, like you're paid to do on behalf of your clients. Like, it all makes sort of rational sense, Jim.
Also, the lack of dismissiveness of the new. I think that's really important. And I think that's something that the old guard takes a long time for them to adjust to this kind of stuff. I can speak from experience. But yeah, other analysts are adapting way faster and give it more credibility.
There's a meme that goes around showing an old Homer Simpson, and it says, old man shakes fist at cloud, because the world is passing him by and he gets angry. And I like to say, look, we're all eventually going to be that old guy shaking our fist at the cloud. Let's just not get there right away. Let's not be in a hurry to get there right away. But you're right. This is as old as time, that change comes, and the old guard, especially in the financial sector, has a vested interest in the status quo. And when you start talking about things, especially in the crypto space, that strikes right at their heart. Look, it's one thing to kind of make them the argument that Uber is going to disrupt the taxi industry in Manhattan. Well, fine. I'm not a taxi driver. I don't own taxis. It's interesting to watch. I'm fine taking an Uber. But when you say to them, oh, DeFi is going to change the basic structure of banking. Hold on, time out a minute here. That affects me directly. And then they push back on that much harder as well, too. So that's what you're fighting against with a lot of this change.
Okay, Jim, closing question. One that we ask a lot of people, favorite ETF ticker?
Oh, probably UFO. I think that's just such a wonderful ticker.
There was not even a pause.
Yeah, no,
that's a good one too.
Yeah, not only UFO, but did you see what it did too? Right after ARK announced that they might get into space as well too. I mean, it became a UFO after that.
Yeah, it grew fourfold. It went from like 40 million to 140 million just on a filing. I've never seen that.
Yeah. If I had to pick a silver medalist, the one that with all women that. Oh
yeah.
That's another good one as well too.
See, and he said he wasn't good with tickers. He knows his tickers.
Yeah, I mean, she is, and that one hasn't been sort of on the front burner for about 5 years. So that's impressive. That's sort of like a deep cut on an album that was popular 10 years ago.
Yeah.
Very nice.
Your 19th
Jim
nervous
Bianco.
breakdown.
All right, Jim Bianco, thanks for joining us on Trillions.
Thank you.